In June of 2026, Wall Street entered an absolute frenzy over SpaceX's massive $86 billion IPO. The event briefly made Elon Musk the world's first trillionaire, granting him a level of market leverage no single individual has ever held. However, a former Tesla engineer warned that investors were playing a dangerous game of crying wolf, pointing to a long history of unfulfilled product promises. This creates a divide between those who believe Musk has discovered a new way to scale capital and those who believe he has rigged a corporate time bomb. Musk's strategic moves throughout 2026 represent a massive experiment in financial leverage, with his entire corporate structure used as collateral for his next ambition. This chart shows the projected growth of the global artificial intelligence market, which is expected to reach $1.68 trillion by 2031. Tesla has reached a critical inflection point where its dominance in the electric vehicle market is no longer enough to secure its future valuation. Competing in the AI space requires massive human capital, with some firms reportedly offering $300 million packages to poach top-tier professionals. To maintain his lead, Musk demanded a pay package tied to a target Tesla market capitalization of $8.5 trillion. The second half of the gamble involved merging AI into SpaceX, using the capital from aerospace operations to subsidize the high cost of AI computing. This strategy ties the fate of his entire corporate empire to a single, highly precarious transition into the AI sector. The grand scale of these plans contrasts with dropping sales and rising safety risks, leading to public protests from groups like Tesla Takedown. These critics point back to the 2016 Master Plan 2.0. 10 years later, the driverless taxi services and electric semi-trucks promised in that plan have yet to reach the market. Internal issues are also mounting at xAI, where half of the founding team has resigned, amid reports that the underlying systems were not built correctly the first time. Regulatory hurdles are slowing the physical build-out as well, with environmental studies suggesting a proposed gas plant for xAI's data centers could cause millions in annual health damages. For a business model built on the promise of a flawless future, these operational failures threaten the underlying credibility required to sustain such high valuations. Tesla's SEC Schedule 14A filing suggests that the primary motivation behind these moves is a drive for absolute control over the AI landscape. Musk publicly threatened the diversion of his AI innovations to private ventures if he did not receive 25% voting influence at Tesla. This pressure is fueled by a massive financial burn rate, including xAI's $920 million monthly bill to Google for compute capacity. To consolidate capital, Musk oversaw a series of rapid acquisitions. xAI bought X for $33 billion before being absorbed by SpaceX. These rapid-fire mergers pool capital from separate industries into a single resource to sustain the artificial intelligence division. By the spring of 2026, the various timelines converged with the production rollout of the Tesla Cybercab. In June, investors assigned SpaceX a premium valuation based on the potential for recurring revenue from Starlink and AI, far exceeding the value of its launch services alone. SpaceX's own IPO filings highlight execution risk, noting the massive gap between the capital being deployed today and the returns expected tomorrow. Despite these warnings, the SpaceX valuation briefly surpassed $2 trillion, and Tesla shareholders approved the $1 trillion pay package. The surge was temporary. SpaceX shares pulled back sharply after only 3 days of trading. While the capital was raised, the burden of achieving an $8.5 trillion valuation remains, leaving the entire empire dependent on hitting nearly impossible milestones. This reliance on a single architect is defined in the filings as key person risk. Musk's involvement across multiple companies creates competing demands for his attention, leaving outside shareholders effectively powerless to influence his decisions. This multi-trillion-dollar market is built on extreme leverage, raising the question of what happens if the architect eventually runs out of time to deliver on his promises.